All right. I think we are live. Testing. Okay. I think we're good. All right. So this is day 3 of studying for the CPA exam using my own personal CPA prep study tools. It's called CPAcioli. Our mission statement is here. It's CPA Exam Prep you can actually afford. So, oh wait, I'm glad I noticed that. Okay, I need to share my screen. Whoops. Okay, entire screen. All right. Now we're rocking and rolling. Thank goodness I didn't stream for 2 hours without that. Anyways, yeah, I'm glad I didn't stream for a while without that. That would have been tough. But yes, so CPAcioli, CPA Exam Prep you can actually afford. This is day 3 of studying for FAR. I've created this myself with the help of Claude and AI, and I've been making improvements and documenting that on my other videos. If you want to watch that, this is just me live streaming kind of how it works and me studying for the exam. Let me know in the chats if you have any questions, and we'll get to work. We've been doing 50 FAR questions a day for these streams, just using the practice mode. That's where the stats sync is using practice mode. And so, yeah, we will do this. I've created a bunch more questions yesterday. I reorganized the formatting a little bit. But when my credit usage gets back for Claude, I'm also going to make these into sub areas so that you can see kind of a detailed breakdown of what you're actually working on. And I got this straight from the AICPA Blueprint website, so it is accurate and up to date with 2026. So we'll do unanswered, and we'll do all difficulty and all topics. Cool. So let's get to work. On January 1st, company sells a product to a customer for $121,000 with payment due full in 2 years. 10% is the appropriate discount rate. What amount of revenue from the sale should be company recognized at contract inception? Cash selling price. I'm not sure. Payment due in full 2 years, but they offered it in the end. Let's try this. Okay, let's see. When a contract includes a significant financing component, the transaction price is adjusted to the cash selling price, discounting the deferred payment at the rate that reflects a separate financing transaction. Okay, so let's see here. Okay, so you do the discount rate for 2 years, so you discount it back to $100,000. Okay, and the $21,000 extra is recognized as interest income over 2 years. That's where's the amount. Product revenue recognized at inception. Awesome. Sounds good. Bad start, but that's okay. Under the full disclosure principle, notes the financial statements are best described as. This should be an easy one. It shouldn't be optional. Yeah, should be that. Cool. The full disclosure principle requires that financial statements be accompanied by notes that provide information essential for the statements not to be misleading, and they're an integral part, so they are required. Cool. And also I'm going to update, I kind of like these stats here, but I'm going to update the stats on the dashboard to make them more advanced and more helpful to the user. So that's another thing that I'm going to do while Claude Fable 5 is available to me before the usage credits apply after July the 7th. Oh, hard one. Company combines them. He combines them and determines if the equipment and installation are separate performance obligations. The combined total contract price is $450. Using the relative standalone selling price method. Okay, I think you would do. My guess would be that you do. Let's see, the equipment is the expensive one. So you do the equipment, which is 400, divided by the total, which is 400 plus 100, which is 500. So you have 0.8, and then you multiply the 0.8 by 450, which is 360. Let's see. Awesome. So basically, you locate it based off of the total price, and then from there you take the contract price and multiply it by the percentage that you calculated. That one wasn't too hard. Cool. Okay. 3 performance obligations. Because I'm going to add a sub topic to here, but then there's going to be 4. So I might have some sort of little drop down here where you can see the details if you want to click on it. Otherwise, it can just show probably just the difficulty level. How should company allocate the $12,000 discount? Should be all 3. Dang. Okay. Why not C? Why not? Guess you don't do it for services. Let's see. Permits an entity to do a located discount entirely to one or more, but not all performance obligations in a contract, rather than proportionally across all of them. when specific observable evidence demonstrates that the discount relates specifically to that subset of performance obligations. Okay. Okay, because services aren't discounted. Yeah. Makes sense. Let's see. Yeah, so the discount rate doesn't apply to the installation services. It only applies to the products. So you locate it between the products, not the installation services. Good to know. It's preparing its bank reconciliation at month end. Balance for bank statement is 8,000. Cash balance. I forget. I think you like. Maybe you subtract the deposits in transit and add the outstanding checks. And 6,500 plus 8,700. Not sure about this one. Let's see. These are tough. You just got to memorize the rules. But let's see here. Okay, true cash balance from the bank is found by adding deposits in transit. Okay. Subtracting outstanding checks. I did the opposite. Okay. Yeah, I did the opposite. So I subtracted that and added that, but it should be, yeah, the opposite. So transfer bank, you add the deposits in transit, subtract the outstanding checks. You're left with 7,300, and then the $50 service fee and the $300 NSF check reduce the book balance to reconcile to the same. Okay, so those are for book balance, but bank balance is just that. Either way, you arrive at 7,300. Cool. Beacon Company used the aging method to estimate uncollectible accounts. Let's see. Year. Okay, I believe it should be 34,000. Because you're trying to get it to equal 40,000, so it's the difference basically. Cool. All right. Question 7. And I might add a back button here, but I don't really see the need. I think the more I think about it, I think I want to add starred questions. So you can star a question, and there'll be a separate section where users can go back and do their starred questions, and then that'll be revealed in the practice section. I think that's would be really nice for some people. Let me know any other features that you would like to see added. I'd be happy to add them. Extinguishment. I think that should be financing the 580. Maybe C. Okay. The full cash paid to retire debt is reported as financing activity, and any gain or loss on extinguishment included in net income must be removed from net income in the operating activities section, basically to not duplicate it. Activities is that. Operating activities, you subtract it. Cool. Since the full cash effect is captured in the financing section. In the year, company issued common stock for $150,000 in cash. Okay, financing activity. This should be easy. Okay, $150,000 in cash. Paid cash dividends. So those are both financing, I believe. So 110 and then repaid. Long-term debt principal. I think repaying interest is operating, but paying the principal on long-term debt is financing. So I think it would be 50,000, 150 minus 40 minus 60, I believe. Cool. Yeah, and they are those are all financing activities. Like I said, though, it would make it confusing if they paid interest. I think that's an operating activity, but since it was principal, then it's also financing for the long-term debt principal. 10% stock dividend. I believe it's still $30 per share, so it shouldn't be B or D. Maybe A? Oh. Okay. Okay, because now, yeah, makes sense because now it's $30,000 for 1,100 shares. So when you divide those two, you get 2727 with no dividend income recognized since a stock dividend simply spreads the existing 30K total cost over more shares. Yeah, that makes sense. Dividing the unchanged 30,000 total cost basis by the new 1,100 shares correctly yields a revised cost basis of approximately $27.27 per share with no dividend income. Because it's not dividend income, it's a dividend stock. Stock dividend, not dividend income. So you basically just get more shares, but now it's less per share. Your cost basis is still $30,000. Okay, let's see. Carrying value goes over market rate. So I think that means it should be discounted. Since the market rate is less, I believe that means discount. No, that might be premium. Yeah, okay, wait. No, if carrying value is greater than market rate, then it should be premium. Bond premium amortization for year one. Dang, I used to know how to do this. Okay. I think it's just judging by the answer choices. I think it's probably A, but I want to see why. All right. Let's do 1,043,761 times 0.05 is 52,188. And then that's obviously 60,000. So 60,000. I think it's A. That's the total amortization. The bond premium amortization. What's this? Okay. But I guess that's given to say it's a 1 year. One-year bond. But yeah, that's exactly what I did. So I did the carrying value, carrying value times the 6% stated interest rate. Then I did the what they paid times the market interest rate. And then, since carrying value percentage is greater than market rate percentage, then it's selling at a premium. I guess you had to pay over $1 million for it. And then you subtract the two to get your answer. So you do cash interest paid minus interest expense equals the premium. for year one. Cool. Okay, consolidation question. And like I said, that tab's going to be up there. I'm going to have a drop down that says show all tags, and you'll be able to see all this. And I'll also probably add somewhere, wherever Claude thinks is best, where you can star one, and then you'll be able to go into the dashboard tab and review it. Actually, no, you'll probably be able to go in the practice tab and review it, because I'll also have separate ones where you can star for flashcards. And the mock exams, I'm leaving them as is. Let's see, based on the price paid for the 8% controlling interest. I feel like this is too easy. I feel like it'd just be 160, but yeah, that was easy. I don't know why it's listed as hard. It literally gives you half the answer here, and you just take the difference between 800 and 640, which is 160. Cool. Question 12. All right. Yay, this should be easy. Net income minus preferred. Yeah, we're doing basic. Net income minus preferred dividends. 550 divided by 200. So 5.5 divided by 2, 2.75. Cool. Wish they were all like that. That'd be awesome. Easy enough. Company has a bank account with a negative balance. Company has a bank account with a negative balance at year end. So a possible balance account on a different bank. Cool. Bank overdraft one account generally cannot be offset against a positive cash balance in a different account. Is that the current liability? Yeah, so the two separate bank accounts can't be combined. Therefore, the overdraft must be considered a current liability because you can't net against the two. You can't net the two together. All right, in business combination, identifies a customer relationship, intangible asset with an acquisition date, fair value of 60,000, estimated useful life of 6 years. Oh, that's easy. Just I guess 10K. Hold up. Okay, we'll see. Actually, is it C or D? Because acquired intangible assets other than goodwill are not amortized. Okay. Identifiable intangible with finite useful lives are amortized. But I guess if they have indefinite useful lives, they aren't. But with finite useful lives, they are on a straight line basis. Cool. Simple enough. Company sells products with a 1-year warranty based on historical experience. The company estimates warranty costs will equal 3% of sales. Cruel approach. Think you ignore the 40,000, what actually happened, and take 3%. So 2 mil times 3% is 60,000, and subtract it. Wait, no, you don't subtract. You're not looking for that. You're looking for the warranty liability. Okay, so you do net it. Dang. So it's six. It was 60,000 estimated, and actual warranty costs paid during the year of 40,000. So I guess just the 20,000 remaining. Okay, and the warranty liability is reduced as the actual warranty costs are paid, with the remaining balance reported as a liability. Okay. So you do subtract actual costs already paid. All right, number 16. A company purchases land for a new corporate headquarters and also pays for grading, drainage improvements, and paving of a parking lot with a limited useful life. Under US GAAP, how should these costs typically be classified? Yeah, everything's capitalized because those were all improvements. So yeah, we'll read it here. Land has indefinite useful life, so it's obviously not depreciated, but improvements to land have a limited useful life. And these were improvements, so they're recorded as they're capitalized and depreciated over their useful lives. Cool. Okay, $500,000 face value bonds with an unamortized discount of 15K. So the net carrying amount is 485. Gone back 470. So I guess would be 15 gain. Nice. So it's the gain or loss is the difference between the net carrying amount of the debt and the reacquisition price paid. So the net carrying amount is the face minus the unamortized discount, and the reacquisition paid was less, so it was a gain, and then you take the difference, 15,000. Cool. What I might start doing for these streams is to throw on some lo-fi hip hop while we study. Let me know if y'all want this. Pretty nice. Oh, some boring stuff, but we're going to get through it. CPA exam. Let's go. All right. This is another consolidation. 75% of subcode for the current year. There's no income of 400K. No intercompany transactions or fair value adjustments requiring amortization. Yeah, I should have gotten that right. It's pretty simple. I don't know why I get 0. Yeah, it's self-explanatory. Shouldn't even have been a hard one. What amount of cash paid for interest should be disclosed? I guess just 45K. I'm not sure though. All right, let's read it. Supplemental disclosure of cash paid for interest includes both expensed and capitalized interest. Cash pay for interest includes both expenses, capitalized interest, adjusted for the change in accrued interest payable during the year. Okay, that's confusing because it says of which 5,000 relates to interest, so it sounded like that was included in that. That's weird. Sounded like that was included in that. Cool. Publicly traded companies preparing its annual financial statements. I think we already got that one, actually. Within the hierarchy of accounting guidance, GAAP, FASB accounting standards, content is best described as. Yeah, just something you gotta memorize. An exchange that lacks commercial substance. Community percentage is 25, fair value is 22. Nice. In a non-monetary exchange, losses, unlike gains in exchanges lacking commercial substance, are always recognized immediately when the fair value of the asset given up is less than the carrying amount. But yeah, if it were a gain, it'd be different, I think. Yeah. Okay, while gains may be deferred in exchanges lacking commercial substance, losses are never deferred. They're recognized immediately regardless of commercial substance, and the new asset's cost reflects the fair value used to measure that loss. Cool. All right. Okay, this is the governmental question. think A. Okay. Okay, unconditional right to receive future cash flows. Because of that, it recognizes it as an asset. And the asset is the beneficial interest in trust. Cool. Related to a company's manufacturing equipment. Not A. Probably B. Should be B. Yeah, when it extends its useful life. When it extends useful life, increases its capacity, or improves its efficiency, or capitalized. Expenditures are just for normal operations. In a reverse acquisition, a smaller operating company. For accounting purposes, which entity is treated as the accounting acquirer? I don't have a clue. Got lucky. Yeah. In a reverse acquisition, the accounting acquirer is determined based on which party obtains control, not which party is the legal acquirer. When the smaller company's former shareholders end up controlling the combined entity, the smaller company is the accounting acquirer, even though the larger entity is the legal acquirer. Cool. Good to know. Okay. AFS security with an amortized cost of $200K. This gain is currently recognized in AOCI. And the Social Security for $225 cash. I feel like it's A. Recognize the full amount of the gain and reverse the $15K previously recognized in AOCI. Nice. Upon sale of an available for sale debt security, the entity recognizes realized gain or loss and net income equal to the difference between sale proceeds and amortized cost and reclassifies any related unrealized amount previously recognized in AOCI out of that account. Cool. Makes sense logically. All right, we're halfway done. Okay. Receives $500K of cash proceeds from selling trading securities. In which section of the statement of cash flow should this $500K be reported? Cash proceeds from selling trading securities. Would it be financing? Interesting. Okay, and which securities are purchased principally for resale? That's why. Operating activities, because trading securities purchased for resale are considered similar to inventory for an entity in this line of business. Otherwise, I think it would be financing. Yeah, trading securities. Yeah. Because trading securities are held for near-term resale as part of the principal operating activities. Similar to inventory. Cool. A licensor grants the licensee the right to use its intellectual property in exchange for a sales-based royalty of 5%. Must be licensed report sales of $400K, subject to the royalty. Sales-based royalty exception. I don't know. When and in what amount should the licensor recognize royalty revenue for the quarter? I would assume this. Okay. When the sale actually occur, because that's when the performance was performed or whatever. Yeah. Point in time performance obligation. Revenue from a royalty based on sales or usage of licensed intellectual property is recognized only as the underlying sales or usage occurs, even if the license itself was granted earlier and would otherwise be a point in time performance obligation. Licensee sales subject to royalty. Royalty rate, royalty revenue recognized for the quarter. Recognizing the amount as the sales occur. Cool. All right. Okay. retains control of the goods until the dealer sells them. Until the dealer sells them to an end customer. Until the dealer sells them to an end customer. So the manufacturer should recognize revenue. Believe it's A. Believe it's A. Okay. Revenue is recognized when control of the good transfers to the customer. In a consignment arrangement, the consignor retains control of the goods until the consignee sells them to an end customer. So revenue is deferred until that sale occurs. Cool. Makes sense. Whenever it transfers control. Okay, a construction contractor has a 2.4 fixed price contract and recognizes revenue over time using the cost to cost input method. Total cost estimate project 1.8 as of year end. Actual cost incurred to date are 720. What amount of revenue should the contractor recognize for the year? Contractor recognized for the year. I'm assuming you would do ratios, so 2.4 divided by 1.8. So it's 1.33 times 720K revenue. And then, yeah, we're looking for revenue, not profit. Hopefully it's C. Nice. Okay. I did it backwards, but did the same thing. So I divided that by that, which was basically the profit margin, or yeah. And it was 1.33, and then I multiplied it by the cost to get the revenue. Yep. Cool. All right. 30 down. I'm not sure. Just guess though. So because the company retains ownership, continues to service the receivables, and keeps the risk and rewards of ownership, the receivables remain as an asset, and the pledge arrangement is disclosed. All right. Increase the fair value of identifiable net assets acquired by 25,000, which reduces goodwill by that same amount, all else equal. Since goodwill is the residual after net identifiable assets, was projected for consideration transferred. All right, a city special revenue fund receives a 400K state grant restricted for youth recreation programs. Incurred. A year in the fund has incurred 250K of qualifying expenditures. Under modified accrual accounting, what amount of the grant revenue? It says when it's measurable and available under modified accrual. So, grant revenue should be special revenue fund recognized for the year. Yeah. With the remaining 150K reported as a deferred inflow of resources. Remaining 150K reported as a deferred inflow of resources. Cool. So for expenditure-driven grants, revenue is recognized under modified accrual accounting only as qualifying expenditures are incurred. Any cash received in excess of qualifying expenditures is reported as deferred inflow of resources until additional qualifying expenditures are made. Cool. Fire destroys the company's entire inventory. Records show beginning inventory of 60K. Purchases during the period of 220K and net sales of that. Gross profit rate is 30% of sales. Using the gross profit method was the estimated inventory lost in the fire. Estimated inventory loss. Purchases during the period of that. It's 280 and net sales at 350. All right. Want to do $350,000 times 0.7 is 245. It's 280 minus 245. $280 minus 245 is 35. I feel like it's B. Yeah. So I multiplied 350 times 0.7 because it's the inventory costs. I got 245. So then I got the 280 minus the inventory that they sold, which is 245 equals 35K. Yep. AMC purchases debt securities and has both the positive intent and the ability to hold those securities until they mature. Should be held to maturity. Cool. Yep, something you got to memorize. Okay, 35 answered. Let's go. Issuance the company stock trades at 50 per share. And you write some sales trade at 5 each. I'm not sure. Just guess though. Stock rights issued pro-rata to existing shareholders at no cost are not recorded with a formal journal entry at issuance since the company has not received any consideration. Only a memorandum entry is made. And the memorandum entry is made and any proceeds are recognized when if the rights are later exercised. Rights are distributed to existing shareholders at no cost. So it's no consideration because it's no cost, so only a memorandum entry is recorded. Recognition is deferred until exercise. Cool. And then business combination accounted for the acquisition method. Goodwill is best described with the following. Yeah, I think it's this. So yeah, 5 goodwill is the residual measure transferred plus the fair value of any non-controlling interest in previously held equity interest less the fair value of identifiable net assets acquired. Company reports income tax expense of $90K for the year. Income tax payable was 12 at the beginning of the year, 18 at year end, or amount of cash paid for the income tax to the company report. So income tax payable increased. So the expense should be less, I believe. So 84. Yeah. Cash paid for income taxes equals income tax expense adjusted for the change in income tax payable during the period. An increase in the payable means less cash was actually paid than the expense recognized. Oof, long one. The leasee enters a 5-year lease with annual payments that are $24K per year, subject to adjustment each year based on changes in the consumer price index. Not sure. I just got lucky again. For leases with payments that depend on index or rate, ASC 842 requires the leasing to initially measure variable lease payments using the index or rate as the lease commencement date. Right. 11 more. Timberline's incremental borrowing rate is 6%. This lease. $9% of the equipment's fair value, so it should be a financing lease because that's one of the things it needs to satisfy. And also, 5 divided by 6 is greater than 75%, so it should be financing. And then let's see the lease liability. I think you do it based on present value. Nice. Lease classified a financing lease when present value These will exceed substantially all the underlying assets' fair value, and both operating and financing leases initially recognize a RU asset and lease liability at the present value of lease payments. Cool. Because the 9% threshold for substantially all the fair value is met. And I think there's 5 criteria in total, but this was one of them. If any one are true, then it's a financing lease rather than an operating lease. All right, 10 more. How is compensation expense for employee stock options measured and recognized? It's compensation expense. I would assume recognize when options are actually exercised by employees. Okay, at fair value on the grant date, recognize over the requisite service vesting period. Okay, something you just got to memorize, I guess. Measured at grant date, fair value using an option pricing model and recognize ratably over the requisite service period. So grant date, fair value, measured through an option pricing model spread over the vesting period. Something you got to memorize, I guess. Under ASC 805, a business combination is a transaction in which an acquirer obtains control of one or more businesses. Which of the following best describes the concept of control for this purpose, consistent with ASC 810? Probably this. Control generally means the power to direct the activities that most significantly affect an entity's economic performance, most commonly evidenced by ownership of a majority greater than 50% voting interest, although control can also arise through contractual or other arrangements. Ooh, hard. Okay, a non-profit organization receives a donation of $500K with explicit donor restrictions. Okay. I feel like yeah, it was that wasn't a hard one. I mean, it's just self-explanatory. At year end, a company has $400K long-term note payable outstanding, requiring principal payments of $80K due within the next 12 months. And student has the ability to refinance 30K of current portion on a long-term basis under an existing refinancing agreement entered before the balance sheet is issued. How should the company classify this note payable on its classification balance sheet? Intends to refinance 30K of current renewal debt. I would think D, because it's 80K due within the next year, but then they intend to refinance 30K. So 80 minus 30 is 50, and then the 30 is added back to the remaining 320 to get 350. Mm-hmm. Cool. A city's governing body formally sets aside $2 million of general fund resources in a budget stabilization or rainy day arrangement. Okay, emergency circumstance. Yeah, committed fund balance. Just something you got to memorize. It's authority. Cool. Okay, company. So it goes from debt security, from trading to AFS. At the day of the transfer, the security's fair value is 85 and its amortized cost is 80, resulting in 5 unrealized gain. Income is 5 unrealized gain. The 5 unrealized gain has already been recognized in net income as it accrued. While the security was classified as trading. It's okay. Because trading securities are already remeasured to fair value each period with changes in net income, any unrealized gain accumulated has already been recognized in earnings. Reclassifying the security to AFS does not require any further recognition of that already recognized gain. The security simply carries forward its current value under its new classification with subsequent changes in fair value reported in OCI going forward. Cool. All right, 4 more. A not-for-profit organization is named the remainder beneficiary of a charitable remainder trust established by a donor. At creation, the trust assets have a fair value of $400K. Value annuity payments being made to the donors designated income beneficiary over the trust term is $160K. What amount? $400 and the present value. The annuity payments being made to the donors designated income over the trust term is $160K. Cool. Makes sense. In a prior year, a company recognized a $200K impairment loss on a piece of equipment held for use, reducing its carrying amount accordingly. In the current year, the equipment's fair value has recovered. Yeah, it's just something you gotta memorize. It's U.S. GAAP prohibits reversing a previously recognized impairment loss on a long-lived asset held for use. The reduced carrying amount becomes a new cost basis, and depreciation continues based on that new basis. Our company issues 10,000 shares of common stock with a fair value of $45 per share. Acquirer also pays $20K in legal fees, which are expenses incurred. What amount should acquirer recognize as considered transferred for purposes of measuring goodwill? So $450K. I guess just $450K because hold up. Their expense. So I guess $430K, $450K minus the $20K in legal fees that are expenses incurred. Dang. The acquisition date, fair value of the assets transferred, liabilities incurred, and equity interest issued. Okay. Acquisition-related costs like legal fees are expensed separately and excluded from consideration transferred. Okay. The $20K of legal fees is recognized as an acquisition-related expense in the period incurred and does not factor into the goodwill computation, consistent with ASC's 805 treatment and transaction costs. Company acquires equipment under a financing lease, recognizing a right-of-use asset and lease liability 180 at commencement with no cash paid. I should try to report the same cash flows. Well, no cash is paid, so it should be that. Yeah. Disclose separately as supplemental information. All right, last one. Let's try to get it right. Should have to do with the equity method. Okay, doing the year investor report net income of 200K. Also during the year, the investor sold inventory to the investee at a 50K gross profit. Okay, investor, 40% of the investee. So you'd take 200K times 0.4, so that's 80. And during the year, the investor sold inventory to the investee at a 50 gross profit, but you're selling it to him, so I think that might have no effect. A 50K gross profit. At year end, 60% of that inventory remained unsold in the investee's warehouse. Let's try 0.6 times 50K is 30, 80 minus 30 is 50. Dang, okay, because I did 200 times 40% is 80K, and I did 60% of 50, which is 30, and then subtracted 30 from 80 to get 50. So let's see what the answer is. In the equity method, an investor defers its proportionate share of unrealized intercompany profit on downstream sales, remaining the investee's in the inventory, recognizing it only as the inventory is resold to outside parties. So share of investee net income. Okay, investor share of unrealized profit to defer. Okay. That. 50 plus the profit. Okay. 30 but times their share is 12,000. Profit to defer 68,000. That makes sense. That's it. Oh, dang, I did go over. We'll answer. Let's try to end on a one we answer right. Company groups several individual machines together as a single asset group for impairment testing. The asset group has a total carrying amount of 700. The undiscounted future net cash flows is 650 and the assets fair value is 600. Okay, I remember this impairment loss stuff. Since future net cash flows is less than carrying amount, then it is impaired. But then now that you know it's impaired, you do the fair value. So 700 minus 600 is 100. Cool. This is measured. 700 minus 600 equals $100,000 in loss, impairment loss. All right, and there you have it. Study session number 3 for FAR. Yeah, it's good stuff. Tune in next time, and once again, the link for this app is in the description. There's a 7-day free trial, no credit card required. So, do it, and then it'll just lock you out after 7 days if you don't want to pay for it. It's $19 a month or around $12 a month if you commit for the year. And there's a lifetime that's $219. So, yeah, let me know if you have any questions or any updates you want me to do the app. I'm going to do some more today. And so I'll have the next version out by tomorrow or the next day. But thanks for tuning in, and I will see y'all next time. Peace.